Okay, guys. Um, Welcome to another lecture on understanding the market business model. So, this is a series of lectures that I've been hosting, and since last month, and we have a plan to, do whatever I want to do within the space of 6 months. So far, I've been able to teach you guys and show you guys one or two things about the fundamental understanding of the whole market as a whole. And I've also been able to bring you into a perspective of understanding as to why as to understanding the rudiments that makes for the movement of for what makes the market function. That's what I'm trying to say. Okay. So we've spoken about the market itself, where I told you that the market is a structure of the economy. There are sectors in the economy that makes the economic function, and the market is one of them. And then after that, I went ahead to teach us about the business. And then the last class we had was we spoke about instruments. And in tonight's class, as promised, we'll be speaking about price. And price is the reason why we are even here to study a market business model. In our focus in studying the market business model is price. Okay, because the moment we go deeper into teaching, you begin to see that price would come out of majority of the things that we do, because this is what we engage as traders. We do not have power over the market. We do not have power over business or instruments. We don't even have power over price, but we are part of those who makes for price delivery. So you must understand that you as a trader, this is where you come into the market. This is what this it's like. Price is that agent that introduced you to the rest. Okay. So tonight we'll be speaking so much about we'll be speaking about price. But before we go into that, um I would like to talk about something. You see, every time you start a journey, it's very likely and very common that you will have to start that journey alone. That nobody would start with you at the beginning. Okay. In fact, the moment you set your mind to something, it is you that set your mind to that thing, not any other person. So it is your cross to carry. And this is where the role of determination comes into the life of the trader. How determined are you to make this market work for you? Because that's what matters. That's what matters. As long as you're not profitable, determination is what keeps you going to make sure that you see that thing that is missing, you get it. Profitability is a reality. It's possible. Anybody tell you otherwise is just trying to bring you into the losers side of the market. But as far as I'm concerned, it is possible. You can literally be among the 1% that makes their daily income from engaging this market, that sorts their bills from engaging this market. And all that is required is adequate information. The thing that makes for generating that result, that is all you need. And now I'm telling you that the market business model has those things you need. Now, what the market business model will require from you is your determination, is your dedication. How determined are you to make this thing work? Is there a hunger inside of you? Because at the end of the day, anybody can just, come to the watch the video and just drop it somewhere. Anybody can just come to YouTube, watch my videos, and drop it and don't do anything about it. But how determined are you? Some of you have spent the past the past weeks that we started this lecture, you've watched the video over and over and again. And every time you watch these videos, you see points that you missed and points that you don't understand getting clearer to you. Yet some of you will just come to the videos, skip, watch. See, let me tell you the thing about growth. The way it works is that, you see, you might be in a lecture that lasts for 1 hour, but all that you need for the transformation of your trading journey would not take more than maybe 30 seconds within that 1 hour lecture. But because of you know how to skip, you don't pay attention. You take it with you take the class with levity. You do not take it serious. You now see that that's 30 second space, that 30 second speech, that 30 second teaching that you need. You skip it. This is where paying attention becomes paramount as a trader. And not just pay. In fact, the moment you become determined, you pay attention. So it's a question of how determined are you, how dedicated are you. Every single thing you need in this market is already here in the market business model. Your job is to listen and follow. But you cannot listen and follow when you are not dedicated. So you have to be dedicated. There is no time to waste. There is no time for you to start gallivanting and still looking for if it is or if it is not. This is the time for you to take your trading life serious. This is the time for you to pull yourself up and make sure that every single thing that is being delivered to you, you're using them well. Because at the end of the day, you see, at the end of the day, you would look at what you have spent the past 6 months doing. And if you had paid attention and you have been deliberate about it, trust me, you'll be happy about the kind of results you will have. Some of you will say, oh, this class is boring, self. It's only me. This one, it's normal. There's nothing special there. There is nobody who started a journey with company. They start alone, especially journey to finding that thing that works in this market. It's usually a separate journey. It's a journey whereby you begin to see things for what they truly are. And the funny thing is that not everybody are going to support you. This is an industry whereby everybody are opinionated about their belief. In fact, many people find comfort in general understanding that do not bet result. As long as it does not require them to put in extra effort, they are good. They are very good. So the moment you come here with something different, definitely nobody's gonna come here, nobody's gonna applaud you. In fact, expect criticism. But the truth is, as long as you do not give up, as long as you keep on firing on, you see, the same journey you started alone, when there are results that can be presentable beyond doubt, trust me, you will not even require people to clap before they start clapping for you. When you know what you're doing, it's like the popular saying, when you are good, you are good. So you're on a journey to becoming good. On this journey is going to be filled with so many things. Remember when you were coming to class, I told you, I said, every single thing you have learned before, throw them away because they do not work. They are not working. And I said, I'm going to start this class from scratch and I'll build an understanding for you guys from that scratch up to pro level. So every single thing that is required for you is just come to class empty with your notepad and your pen and listen attentively. There is nothing that is, when we started it, I said everything in this market is possible. There is nothing impossible. The moment you start following the general narration of some things are impossible, you too, you start manifesting impossibilities. In the market business model, we believe that understanding price is possible. Understanding price delivery is possible. Knowing what would happen next. You see, this series of candle from this top down to where it is now, we can tell that it would happen. That the next candle, we can tell what it would most likely be. That is why the market business model stands out. So, dear trader, as we proceed in our class, I implore you to please pay attention, listen, write things down. Because from here on, the classes are going to be complicated. When I say complicated, I'm not talking about, not understandable. I'm saying if you don't pay attention, you would miss vital points. I'm not the kind of person that rush my class. I'll make sure I touch every single thing. If I cannot finish everything in a video, I push it to the next video. But I will never tell you that, oh, I can't continue doing this teaching. Let's keep it and move to the next one. No. As long as it is needed for the understanding of that topic, I will teach it. So the problem would definitely not come from me. It will be from you, the trader, who is not paying attention or who was not paying attention in class. So please pay attention and listen. Because at the end of the day, even if you learned everything, you will still need to pay attention to what you're doing in front of the chart. So let's imagine you have learned every single thing that makes for trading the market business model. You still have to pay attention. So if you do not groom paying attention here in class, is it in front of the chart you pay attention? You need to be able to know all these things. Relax, no need to rush. I'm not rushing, you're not rushing. Let's take this thing slow. Let's teach let me teach while you listen and you grow. Okay? So that's it. Let's get down to teaching. Now, we are building understanding for the concept market business model, and we're currently in price. But I want you to know two things. There is difference between price fundamentals. Okay, today we'll be talking about price fundamentals. So let me just type that out so that it will not, because today we'll be talking about price fundamental, which is still on. Okay, so under price we have let me put it this way. We have two categories. Okay, the first category is price fundamental. That's price fundamentals. Okay, and the second category is price delivery. Okay, so these are the two categories on the price that we're going to be looking at. Okay? Please follow up. I'm going to explain everything for you. Just follow up. Now, last time in our last class, I explained, so I'm going to delete this. I don't think we need it again. Now, last time I explained instruments for us. I said, instruments are that things. They are those things that makes you to have the ability to come into this market. They are the assets. It's like a shop. When a shop is just there. But how do we know what kind of shop is there? By the instruments that they have. And that this instrument is what makes this business to function. So you see that shop is empty. But the instrument they put into that shop is what will let us know what kind of shop it is. So if you see them bringing oven, coffee makers, all those things, you can literally predict that, okay, this might be a restaurant or an eatery. If that same building, they brought in, let's say, stapler, printing machine, what's it called now, printer, all those, stationaries and all, you can predict that that place would be most probably be an office apartment. The shop did not change. It's not the shop that changed. What changed was the instrument. So it is the instrument that helps us determine the kind of business that is going on. That's why the instrument, the way AU performs is different from the way the way Australian dollar performs is different from the way the euro would perform. So I explained to us what instruments are and how they function and how they relate with business. Now, you cannot trade this instrument without price. Now, you see, if you go to your local market in your place, you most likely, let's say you want to buy tomatoes. This box now, I'm representing this as tomatoes. Tomato is what is there. That is what's it called now? That is what the person who is selling, the trader who is selling, okay? The person has tomato. But this tomato needs to be weighted. It needs to be measured. We need to know the value of this single tomato. We need to find a way to know that what is the worth of this tomato. Now, I will tell you what determines the worth, but for now, but yes, I can literally tell you that what determines the worth of this tomato is price, which you are correct, but you are actually wrong when you say it that way. It is not price that determines it is not price that determines the value of the instrument. This is where many people get it wrong. Price only shows the value of the instrument. It is not the determinant. It is just like it is something that shows what it is. Price is like an indicator that shows what that instrument is. Okay. So the video stopped recording, and I honestly don't know why that happened. So we're back. So let's pick up from where we stopped. Okay? Now, I was using the analogy of you going to your local market, get tomato, okay, and in fact, let me not use a tomato again. Let's use an orange, or let's use orange juice. I think orange juice is proper. Now, this is you. This box here represents you going to your market, and this box here represents the person who is selling the tomato and the orange juice rather. Now, when you go to the market, please, I am giving you a fundamental explanation of what makes a transaction happen. Okay, this is what happens when you go to the market. Remember the market. So we have marked the market. Yeah, so you go to the market. That is the first thing we can say. Okay, oh, market is marked. You've gone to the market. Or in fact, let me do it this way. Let me explain it before I start noting things out first. Okay, now you go to the market, your local market, and you meet the orange juice seller. And for you to get this orange juice, you must have something that you would be able to give to the orange juice seller so that you can in turn get the orange juice, right? And that was what I was explaining to you as exchange resources the other day, or exchange resource in, I think it was in market when we were explaining market. So both of you must have exchange resource. That's what makes a transaction possible. So go to the market. Let's say you have 50 USD with you. You take your 50 USD to the market. You give it to the orange seller in exchange for orange juice. Okay, give it to the orange juice seller in exchange for orange juice. 50 USD there. Now, this person who sells the orange juice would then give you the orange juice as a return for your money, for the cash, that's for the 50 USD to drop. Now, you got orange juice, you gave out 50 USD. So the worth of orange juice is 50 USD. Okay, so your 50 USD could get you an orange juice. Your 50 USD could get you an orange juice. So the price for an orange juice is 50 USD. Now this is where it gets funny. The price for 50 USD is also orange juice, which means that if you have 50 USD, you get orange juice. If you have orange juice, you get 50 USD, right? This is where transaction is now a funny thing. Now this is where listen to this explanation I'm giving you now. This is where it now becomes something. This is where the market is now. This is what makes the market dynamic. And this is where claiming and shouting and screaming that the reason why markets will go up is because buyers are more than sellers. If you keep on saying that statement, you're wrong. There is nothing like buyers. That buying in this market is a consequence of the reason for the need to buy. So people who were buying or people who are buying, they had the need for that currency. That's why they're buying. So if you are following people who just because they have the need, then you're wrong. You don't follow people. You don't follow. I've told you in the market business model, we don't follow people. We don't follow buyers or seller or the banks or algorithm, whatever. We don't. Our focus here is their business. So why are they buying? Why do they buy? Why do they need to buy? That is our focus as traders. In fact, the idea of buyers and sellers is flawed. Because in this transaction scenario I just painted to you, who's the buyer? The guy here, yes? The one with the 50 USD. And who is the seller? The one with the orange juice. But this is where it becomes very, what's it called now? This is where it becomes very funny. Because if you can exchange 50 USD for orange juice, and you can also exchange orange juice for 50 USD, which means both of them are measured in value, which means 50 USD and orange juice are the same value. Yes, it means that somebody with orange juice would actually be buying. So in this scenario, we'll just put orange juice above here, 50 USD here. So we'll now say, let's imagine that this guy now has orange juice and then he needs 50 USD. What does he do? He sells it to this person and this person gives him orange juice. So you can see that the instruments are matched in value. This one here is the same worth as this one here. Notice I'm not talking about price. I'm using the word worth. It is worth the same thing. Okay? So let me swap that back because I like the way it is up there. Now, if it is true that both of them are in worth, okay? Now, let's paint a scenario of this let's imagine you were not there when this transaction happened. All you knew was that 50 USD and orange juice was transacted. You didn't know who was buying and who was selling. You didn't know who came to who first. All you knew was that this 50 USD and this orange juice were both transacted. They were both, this were what happened. It was 50 USD and the orange juice that was used, that were transacted. If that is all you know. Nobody told you if it was 50 USD that was used to bought orange juice or it was orange juice that was given to get 50 USD. How will you be able to tell? Exactly. Now you see where the idea of buying and selling is flawed. How will you be able to tell that, oh, it was 50 USD they used to get orange juice, or orange juice was exchanged for 50 USD? How do you know if it's 50 USD that they used to buy, or it was orange juice they used to it was 50 USD they used to buy orange juice, or it was orange juice they used to buy 50 USD? How? You can't tell. Except they now tell you that, oh, 50 USD was used to buy orange juice. You can't tell. So this is where the idea of buyers and sellers are wrong, because you don't even know. You don't know. So claiming to say a price of a commodity goes up because there are more buyers, you are correct, but on a surface level. You are correct because that is what happened. But why did the buyers, why did they buy? Why were they buying? That's your question as an MBM trader. We don't care about what they do. We want to know why they did that thing. Because the moment you know why they are buying, you know that you are on the right side. Whenever you are in that mode. The same thing for selling. And let me take this explanation even a little bit further. Let's take it more advanced so that I can still buttress this point of buyers and sellers. In this same transaction of orange juice and 50 USD, now please look at it carefully, as I'm about to tell you this now. This person who have 50 USD, he gave it to the orange juice seller. So we can say that he bought orange juice, yeah? And this orange juice seller gave the orange juice to the 50 USD guy. So we can say the orange juice seller sold orange juice. So this one gave 50 USD, used 50 USD to buy orange juice, right? But this one sold orange juice for 50 USD. I hope you get now. So this one is buying and this one is selling. Yeah? Good. Now, do you know that we can also say that this guy sold his 50 USD and this one here bought the orange juice? This is what I'm saying. So as this guy is giving the 50 USD to buy orange juice, is at the same time selling his 50 USD to this person for the orange juice. Why? Because of worth. Both of them are worth the same thing. So this guy is selling 50 USD to this guy, to the orange juice seller, and the orange juice seller is buying 50 USD from him. And the orange juice, sorry, is this guy is selling his 50 USD to the orange juice seller, and the orange juice seller is buying that 50 USD from him with orange juice. So he is selling 50 USD to this orange juice seller for orange juice, and the orange juice seller is buying orange juice from him for 50 USD. So you see the table has turned now. At first, I said this guy bought orange juice from this guy here with 50 USD. Now I'm saying this guy now is the one that now bought 50 USD from him. So both of them are actually buying, and both of them are actually selling. At this, that's why the forex market is I don't know the word for it. Yeah, it's simultaneous. As you're selling your money, you are also buying this. So on a single side, you are both buying and you are selling. That's why I said there is, I think in that our class, I said, as you don't buy and you don't sell, we bid and we ask and we auction. Because now it becomes flawed. The idea of buyers versus sellers now becomes flawed. The idea of demand and support, supply or support and resistance, this is another reason why it's flawed. The idea of patterns, this is another reason why they're flawed. The idea of overbought and oversold, because the idea of what is it called now? Bullishness, because there are more buyers than sellers, is wrong. Why? Because those who were buying at the same time they were also selling. That's how it happened. To buy this currency, you must be willing to let go of this one. So as this one is going up, this one is coming down. Yes, as this one is buying, this one is selling simultaneously. So how do you now know if it's who is buying versus who is selling? So there must be something. Okay, if this analogy I just used for you is correct, the fact that the instrument of exchange cannot be known. In this forex market, you can't know. They're not going to tell you that the reason why euro is going up is because of, no. It's because of, okay, the reason why USD is going up is because of somebody come and buy 50 USD. But the reason why orange juice is going up is because somebody was buying orange juice. No, that's the market is not going to show you all these things. The forex market is not this detailed. The only thing you will know in this forex market is that this whole transaction happened. So first they performed the transaction. So they have done the law of the market. So they have based on what I've explained to you, a market is anywhere a transaction happens. So as long as this transaction happened between these two people, a market has taken place. The second thing is that they've performed business. Okay? And what was the business? Buying of orange juice. In fact, we can't even say in the based on the explanation I gave you now, let's imagine I didn't tell you this was the buyer, this was the seller. We can't even tell who was buying or selling. All we will know is that a transaction happened. So this is where you see this business of a thing. This business is our focus as a trader. So now we're going to explain their business. We have explained markets. Now we'll explain their business. Why was this guy pushed to buy orange juice? Why? Okay. And then we also have the instrument they used. Yeah, the instrument has also been checked. The instrument have also been checked. Yeah. So That is 50 USD in exchange for orange juice. That was the instrument, the exchange resources. Now, at what price did they deal? Remember, our today focus is actually on understanding why this price. Why is 50 USD worth orange juice and why is it not 100 USD? That's the reason why that's what I'm explaining. So all these things I'm taking you to help you build understanding for the reason behind price. So the moment you understand the reason behind price, yes, you stop worrying yourself about all these things on the right side of this thing. Okay, all these things here. So the moment you understand this, the focus now shifts to something else. Now, still on this example, I deliberately using this example because I don't want to use currencies yet. So that by the time I'm done using this, something you are familiar with, and I go to the currencies, you won't have any issue understanding them. Now, their business, okay, you see this thing, business is what we are here to study. The business questions number one, why did this guy, of everything, thinks that it is orange juice you should buy? That's one. It also questions why this person here is willing to sell orange juice. Because if orange juice is bullish, let's say the orange juice chart is bullish, or everybody in the country is buying orange juice, why was this guy willing to sell orange juice? Isn't it supposed to be on the buyer side so that the whole market will be a one-way market? So what's happening? This is another thing why the idea of buyers are more than sellers are wrong. Because if you are telling me that buyers are more than sellers and everybody is seeing that a currency is bullish, then why are they not buying? Why are they sellers? Why are people still selling? Why are they still selling when they know that this currency will be bullish? Why are they not buying, just buying? Why? I mean, it just makes sense. Why is it? I mean, I'm not talking about people only, I'm talking about banks, every other participant in this market. Why aren't they on the bullish side? This is to tell you that in the first class where I taught you that not everybody in this market are here for profit making. This is where it comes into play. So we are here to question the business. So this business thing has not been answered. So I'm going to delete it. This business has not been answered. It is this business that will now help us understand price. That's what I'm going to explain. This follow-up. Now, the forex market does not show you who is buying and who is selling. It doesn't show you which instrument is used as the medium of exchange. If it was 50 USD that was used to buy orange, or if it was orange that was used to buy 50 USD, it's not going to tell you. But the forex market will tell you that if this particular transaction, what so amount is going to happen. I'm sorry, is what happened. Now, this is where it becomes interesting. This is 50 USD, right? Good. So what the forex market will show you is that 50 USD, 50 USD plus orange juice were both transacted, the base and the quote. So the base instrument is 50 USD. The quoted instrument is orange juice. So what we tell you now is that both of these transactions, both of these instruments were transacted. So instead of it to show you just 50 USD, it will show you, since we are trading currency, this is where currency now gets interesting, to show you the value worth of this orange juice in currency. So it will become 100 USD shown here. So all the market will show you is the volume, 100 USD. It will not show you that, okay, 50 USD was for the buyer, 50 USD was for the seller. No. Now, if the market can only show you just 50 USD, I'm sorry, 100 USD that happened in the whole of this transaction, then how do you know that it was 50 USD that was for the buyer and 50 USD was also for the seller? Why don't you know that? How do you know that it was, I'm sorry, how are you sure that you are not wrong? How do you know that? How can we tell that instead of 50 USD now, the buyer was actually bringing 10 USD and 90 USD was coming from the seller? How do we know that, the buyer was actually bringing 80 USD while the seller was actually doing 20 USD? You get where it's interesting now? Because at the end of the day, what the market just shows you is what? $100. It doesn't show you the buying side or the selling side. It just shows you what happened. So how can you tell? This is where the market business model comes in. This is where the market business model stands out. Now, before we even start saying how can you tell, or how can you tell which is which, let's go back here to explain everything that's happened here. Now, let's start from asking the question of why would this person buy orange juice? Why was he interested in buying orange juice? And why is it that he was not selling orange juice? Why was he interested in buying? And this is where we now go back to the first topic I taught you guys. The sectors in the economy. Government and the banks and the markets. The three tripartites. The three of them that makes for the whole gyration of everything that happens. So if somebody says he needs orange juice, why must he? If somebody is buying orange juice, why was he buying orange juice? The answer there is need, because he needs it. The word need is a word, N-E-E-D now, need, N-E-E-D, need. The word need is a word that shows desire, and desire can come as a result of scarcity. It can come as a result of coerceness. You can be coerced into getting you. See, you cannot tell me that the reason why this person is buying orange juice is because he feels like buying it only. There are different reasons why people buy orange juice. Some will buy it because of they just want to buy it. Some will buy it because of the economic situation is not permitting them to buy anything other than orange juice. Some will buy it because of there is scarcity of orange juice. Some will buy it because of so many reasons. Some will even buy it just to waste it. We don't need to know the reason. We don't need to know who is buying. As long as we know the reason why they are buying orange juice, then we can tell that orange juice is the smart thing to start buying. Now, how can we tell when it is time to start buying orange juice? We don't need to wait for this guy to bring 50 USD for us before we can start buying. We don't need to wait for them. Because at the end of the day, you could actually be the one with 50 USD and buying this market. This is where the idea of the old market makers thing is wrong. What if you have the equivalent amount? You are so rich that you have value worth of the amount that the market makers have. So if the market maker have 50 USD and you also have 50 USD, and before the market maker comes into the market to buy, you pump money into this market and you bought 50 USD, and then everything starts going up. Was it the market maker that caused that move? No. Who caused it? You. Somebody somewhere. This is why I don't believe in the whole idea of institutions and whatever. Because they are flawed. The market don't tell us who is buying or who is selling. So as long as the market don't tell me that, then you cannot come and tell me that it is somebody somewhere that is buying all these things. As far as I'm concerned, I've not even seen one person who claims that it was the one that bought a particular move in this market. All I have ever known was that there were economic happenings in the world, and I used to see them reflect in front of the chart, and that should be your focus as a trader. Economy. Because why would even the market maker be willing to buy a currency first? Have you asked yourself the question? If it was market makers or the banks or whoever you feel are actually the one pushing price up, then why would they need to even feel like buying in the first? That's the question. So our question is not what they are doing. Our question is, why are they doing that thing? Why would they do it? Their brain is what we are going into. The moment we have answered our questions, then we don't have to start worrying about who is buying or who is selling. Focus on something else, something more supreme. The market don't tell you who did what. It only told you what happened. So back to our example now, back to what I was illustrating that. You see this person who is buying, how do we know that it is smart to start buying? Because his buying does not mean that you should buy. This is why majority of you will not see buying candles go up before you know you start selling. Because you were following you were following candles, you were following people like yourself in this same market. It's just that you don't have their money. If you have the same money like them, you too, you can cause all those moves. So it's not about who is doing it. There's nothing special about somebody somewhere who is causing price candle to go up. We don't care about them. Our focus is on why are they doing it. And this is where we go back into the economy. We go back to economy. The economic factors I explained to you. Economic sectors. The government, banks, the other sectors in the economy, and the market. That's when we go back. It's very simple. If the government of a country, let's say USD for example, decides that orange juice is, or let's say for example in the country USD, let's imagine that United States are the largest exporter of orange juice. All of a sudden, there is a pandemic affecting orange. What do you think would happen? It will affect the production of orange juice, right? So as a sensible person, what do you think will happen? Because of there is scarcity. Remember I talked about scarcity, need. Because of there is scarcity of orange juice, buyers. Now these buyers are wholesalers, some of them are wholesalers, some of them are retailers, some of them are big companies, some of them are big factories, some of them are just household people. I don't care. As long as you are using something to get orange juice, you are on the buying side. Buyers would see the need to do what? To buy orange juice in massive quantity. And the moment they start buying orange juice in massive quantity with their USD, what happened? Orange juice start going up. And what happened to USD? USD starts coming down. Why? Because they are selling their USD massively to buy orange juice. So the orange juice start going high in what? 50 USD start going what's it called now? USD start going high, lesser in what? So it means that if this orange juice was worth 50 USD last month, this month you will have to pay 100 USD. You are paying more to get the same. You get what I'm saying? And the moment you keep on paying more to get the same, remember you are dropping this one while you are picking up this one. So we are looking from the perspective of the buyer. We are not looking from the perspective of the sellers. We'll look at the perspective of the sellers first. Remember, you are buying. So you are actually dumping 50 USD and you are getting orange juice. But remember I told you that the sellers are actually buying your 50 USD to give you orange juice, yeah? Good. Which means that USD should be bullish too. Yes, USD should be bullish too. Why? Because this is buying happening. So why is USD not? Why is it that USD does not when orange juice is going up, USD is not going up too? Now the interesting thing is that orange juice might be bullish while USD will be bullish. This is where the idea of correlation is flawed. Yes, and I'm going to explain to you. I'm going to explain to you. Just listen. If they are selling if they are selling USD, not 50 USD now, USD to buy orange juice massively, to cause an increase in orange juice. And what was causing that thing? Scarcity. So the economy is what determines. So both your market makers, your whatever, they are going to invest in orange juice. And then price now start going up. Orange juice price now start going up. The price for orange juice now start going up. Why the price for the other commodity are dropping from the buyer's perspective. Now, from the seller's perspective, when what is making them to buy this USD from you and give you orange juice? Because is it not sensible for the sellers to come and join the buyers? But if the sellers come and join the buyer, who will sell to the buyer? Who? Body. So why are they on the selling side? You see why the idea of buying and selling is now flawed also? Oh, there are more buyers, there are more sellers. No, bro. There is a reason why these people are selling. There is a reason why these people are buying. Now that we know why these people are buying, let's know why would these people be selling the orange juice despite its scarcity. Now this is where what's it called now? This is where volume now comes into play. You know, orange juice is the commodity. Is the commodity that is being exchanged, with currency. This supply, you see this supply, what is it called now? The sellers, those who are selling, they don't necessarily have to buy this. All they need to do is to have other things that could help them produce orange juice. You get? So they will have the factory, the machines, the orange, and the farm. That is everything that they use together to produce orange juice. So the sellers had a source. And if they don't sell, they are going to take loss. Why? Because based on what they have in store, that is based on what they have. So so this first place now, let's say they have a factory for producing orange juice. Then this second place, they have the machines for producing orange juice. The third one, they have what's it called now? The farm that they plant the orange trees, and there they have the oranges that is being processed into oranges. So you see that the production of this does not the production of orange juice is not orange juice. It is something else that brought about orange juice. The packaging would even be the packaging that the orange juice would be inside would be from another industry. You get? So producing orange juice does not require them to buy USD. It only requires them to use USD to purchase from other sector in the economy. Now, this is why USD will now start selling. Why? Because these people are now spending USD to get things to produce orange juice. That is, the sellers are selling USD. And the buyers are also selling USD to do what? To purchase orange juice. This is what caused this currency, this USD here. This is what caused it to start selling. Because both the sellers of orange juice and the buyers of orange juice, yeah, because both of them are selling the currency. Both of them are doing what? They are selling the currency. If these people refuse to sell USD and all they want to do is just to sell the orange juice they have in store, trust me, USD might not, start crashing. Because the buyers will just be pumping money here, or pumping money here, accumulating, and this money is not going out. And this is where explaining the next thing comes into play. So in a buy-side scenario, when you see, so you begin to see that orange juice price start going up because the production cost for orange juice is now expensive. Right? So these people will put, the sellers will, let's say, start increasing the price. Okay, once they increase the price, they will have to, sell the USD so that they can match production cost. Then the buyers will come in and then they buy from them and orange juice starts going up. This is what caused everything you see in the market to happen. Those prices you see in those charts is what caused them. I'm using orange juice. I'll still go into currency. I'm deliberately taking my time to explain it. Okay? Now, the idea of what's it called now? The idea of divergence, is it divergence you call it? Yeah, correlation is flawed in this scenario. Because if these people refuse to let go of the 50 of the USD coming to them, and trust me, USD might keep on going higher while orange juice too is going higher. So both, there must be a selling, this thing, a letting go. That's when you now see this thing dropping. Now this is what will now take me to explaining it properly. Now listen, you see everything I've explained to you so far. See everything I've explained from the first moment I draw this box. And let's bring it into the chart. I'm sorry, not the chart. Let's bring it into professional analysis now. Let's talk as professional analyst. Okay? In the market that me and you will trade, there is something called volume. V-O-L-U-M-E, volume. Volume means the inflow and the outflow on a currency pair. See, I'm speaking in our language now. I'm no more speaking in analogy. Inflow and outflow on a currency pair. That's what it is. That's what the volume shows you. Volume tells you that there are, let's imagine that volume tells you that in this old transaction, that happened here, volume tells you that there are $1 million in total. In the old transaction that happened here, everything that happened cost $1 million. Now, the volume will not tell you, okay, so 50 million, 500,000 was from buying, 500,000 was for sellers. No. It will not tell you that the buyers are in no, volume would only tell you that this was the amount that came in. Now, it is your job as the trader to now know who are the ones, what is happening exactly, and where would price go. Because the moment there is this amount this $1 million coming into inflow, okay, or $1 million. Now this is where the buying and selling thing is also wrong. Now the buying and selling things is flawed. The whole idea of price moves because there are more buyers and more sellers is wrong, because volume only tells you inflow and outflow. It doesn't tell you that this amount was for buyers and this amount was for seller. Now let's imagine I put in 50 million, I'm sorry, 50,000, 500,000 rather, dollars on the buying side, and the selling side bring $500,000. What will happen? There is a balance between both sides. You get? So what will happen? There will most likely be no move. And this is the reason why you see those your consolidation. The buyers comes in with 50, with 500, the sellers comes in with 500. Buyers are matching sellers. The volumes are matching the volume. Volume are matching the volume. So it starts consolidating. Now, how does price move? Okay, price moves based on outflow on a currency pair into another currency pair. This is what we call money flow, value, money flow, value flow. What do they call it now? There's a word for it. Yeah, when the money is moving or wherever, you get. Once there is amount of volume that comes in here, let's imagine that there is, out of this $1 million that was transacted in these two currency, just $50,000 came in as a buy side. We can't know. But I'm explaining something to you. Let's imagine that 50,000 USD came in for AUD USD from the buy side. And then what's the remaining one? If you remove 150 from $1 million, it will remain $950, $950,000. Now, if $950,000 now goes into the United States dollars, what would happen? The United States will definitely go up. Now, this is where correlation is wrong. There was inflow on AUD, but the inflow here on USD was more than that of AUD. I hope you get what I'm saying now. The funny thing is that there could even be balanced inflow. So there is 500 USD here, there's 500 USD here, and then what happened was that 450 was pulled out of UAUD. Yes, it can be pulled out. Yes, they could pull the money they put in. It's just like your limit order. If you place the limit order on your broker, that order becomes registered in the logbook, but it is not activated yet. So you can actually still cancel that order. Although that order was in the logbook, but the moment you cancel it, what happened? It gets removed from the logbook and you're no more part of the trade again. You're no more part of the participant. But at a point, it was there. The flaw is that this market does not show us all these things. We don't know. We can only start predicting and projecting and trying to be sound smart. But if you don't know something, you don't know it. And that's fine now. That's what? That's fine now. So you see, the volume comes into here and it's registered. The volume comes into here and it's registered. So now how do we know which of these guys here has the largest volume? This is where the market business model now comes into play too. That's why the market business model is supreme. The supremacy of the market business model over every other thing. It will tell you You get? We're still talking about the determinant of price. See, we are still on price fundamentals, and we have not even touched price fundamental. I'm explaining it. I've not shown it to you. Now, there are a lot of things to speak about. But if I cannot finish it in this class, we'll proceed in our next class. Because I don't want the videos to be too long. You get? Now, you see the whole volume, since we don't know which is coming from which, and I've already told you that the MBM will tell us that. Now, let's explain this thing further. Let's dig deeper. If it is true that volume comes into AUD and volume leaves AUD, and the market does not tell us if it is outflow or inflow, it only tells us the amount of volume that is coming. And it is also true that volumes comes into USD and leaves USD also. Okay, volume is recorded, okay, here. And the market does not tell us if it's leaving or if it's exiting. All we know that everything is still registered at volume. But we know that that's what is happening. Yeah, good. Then it means that for USD, for any condition for USD to be bullish, the volume of USD must be higher than that of AUD based on inflow. And for AUD to be, higher than USD, the volume of AUD must be higher than USD based on inflow. Conversely, for USD to be higher than AUD, I'm representing this box now as AUD. Sorry, I did not note that at first. I'm no more using, remember I told you I'm no more using the orange juice example again. We are matured above that now. Now let's speak the language of the market. Okay? No more orange juice seller. Now, if based on what I've explained to you, for AUD to be bearish, there must be outflow from AUD. Remember, I'm not saying that outflow from AUD into USD. I'm just saying outflow from AUD. And from USD to be bearish, there must be outflow from USD. I'm not saying into your AUD. And for AUD to be bullish, there must be outflow from, there must be inflow into AUD. For USD to be bullish, there must be inflow into USD. Now, if this is correct, that means that every time USD starts selling and AUD start buying, that means there is more inflow into AUD than USD. Good. Now let's use one scenario. Let's take this scenario one after the other. Please, I'm painting something, so please follow up. Let's imagine that out of this $1 million that came into this market, out of this $1 million that came into this market, let's imagine that $1 million, even all the $1 million came in to this market, was actually an outflow from AUD into USD. Remember, it could not be USD. It could be into something else. It could be into something. Remember when I was explaining to you that time, I said, as long as there are economic factors that contribute to this thing selling, it doesn't necessarily have to deal with USD. If, let's say, for example, money is leaving AUD into gold, and everybody is buying USD. Money is not leaving AUD into USD, but AUD will still sell. Why? Because money or volume is living here. It's living while money is coming inside here. So the reason why USD goes up is not because of AUD and people were selling AUD to buy USD. Don't get it wrong. Don't get it wrong. Although because of we deal with currency pair, you can say it's correct, but it's wrong. When we get deeper into explanation, you will understand why. And this is where the idea of correlation is wrong. So what if the money that was leaving AUD was actually also going into EUR? So AUD is being sold. Sorry for that. That's not what I want to say. Because remember, we are in the exchange market. So anything can be exchanged for anything. It's not limited by anything. So AUD was actually exchanged, was actually sold off for EUR. Remember, you have been taught that AUD USD and EUR USD are correlated pair, yes? Well, they are correct, but there are consequences to why they correlate. They don't work every time. And this is why MBM don't teach you what works halfway and don't work the whole way. So if this AUD is being converted into USD and is also being sold and is being sold into USD, USD will be bullish. Also sold into EUR, EUR will be bullish. So what will happen now is that USD is positive, is bullish, EUR would be bullish, AUD will be selling. So AUD USD selling, EUR USD buying. So you can see that both of them are now negatively correlated. This is why you see that sometimes your correlation don't work, because they don't work. In MBM, we only teach it as divergent, and you can tell when it will happen, which I will teach you guys in preceding classes. So AUD can be converted into different other currencies, which is not USD. So AUD can actually be selling while USD is also selling. So everybody could actually be dumping USD and at the same time dumping AUD. The idea of correlation is flawed. Every currency stands alone. Don't treat pairs as a singular currency. A pair is just an exchange. Remember, when you see AUD USD, GBP USD, what you are doing is just an instrument for you to make transaction, exchange. So don't be a fool to think that because of AUD is buying, EUR must buy too. They are correlated. And the reason for their correlation, I will explain it. But for now, don't think that correlation will always work. I'm just explaining that to you now. Why are they correlated? They are correlated because of the value of USD. USD is the most liquid pair in the market. And all these currencies are pegged to the USD. So if anything bad happens to USD, what do you think happens in the United States? What do you think will happen? Volume will start leaving USD. Now, once this volume leaves USD, what do you think the volume will be going into? It will be going into EUR. Let's say this is EUR. Another box. Let's imagine this one. This one here is sorry. Let me just represent this one here as GBP. So volume is leaving USD going into EUR, leaving USD going to AUD, leaving USD going into where? GBP. So everybody is selling USD because USD will now start. Everybody is dropping USD. It will start dropping. The participants are dropping it, and what are they converting USD to? Some are buying AUD, some are buying GBP, some are buying EUR, some are buying NZD. That is why you see that all these pairs are correlated. They are correlated because of the thing they are paired with. It is this currency they have. If you don't pair AUD with USD again, see where they will be. You will know if they are correlated. They won't be correlated. So the reason why you see those correlations is because of this same volume leaving USD going into other pair. And that's why you see that the moment USD start becoming bullish, money is leaving all these guys going into USD because that's what they are paired with. And why are they paired with USD? Well, the explanation is long, and I'll have to start taking you into history of money, gold standard, and all those kind of things, bonds and all those things, which I don't want to explain. Probably maybe in our next, in our preceding class, I'm going to explain. Not now. I'm just teaching you price fundamentals. Since morning that I've been explaining something, we have not talked about what is determining price. That is where we are going to. And I've not even gotten there. So now let's move on. Now, the moment we now understand that the bullishness of a pair is not by buying power, it is by volume. Which means that you say this volume, that this AUD that you see is going up, that move, the volume could actually come in not because of buyers. It could just be government pumping money into the economy. Let me explain. Every time during an election, let's imagine there is election in Australia now, and they need currency. What would happen? They will pull out, because they cannot spend USD in their country. It's AUD they can spend because it's their country, it's their continent, Australia, their country. So they must use the Australian dollar is what they spend there. So let's say election is at hand and they need funds. Now the government will now order or have to write to the central bank there, the Central Bank of Australia there, and the central bank will pull out money, millions of Australian dollars, or not, if not billions. And once they pull out money, what will happen? It will reflect here as volume. What will it show? Let's imagine they pull out $10 million. It will reflect in the market as $10 million. Once they pull out, are they using it to buy USD? No. But is money leaving AUD? Yes. Yes. So the moment that pull out comes, it will show on the chart that a volume has happened. And the moment USD, and now USD does not even need to do anything because USD naturally is a stronger pair than AUD. Just the fact that they pull out this money would naturally cause that sell. And that's why you start seeing that AUD will start selling USD. And because of his selling, you now see your buyers, your sellers rather, people who think that the sellers are in control, you'll now start shorting AUD to buy USD. But imagine if you can know beforehand that this is the reason why AUD is selling. And you still don't have to go and start following up on the news. Yes, you don't need to follow up on news release on what's happening in AUD. MBM got all those things covered. I'm just explaining the fundamentals. So this money that was pulled out, was it sellers that pulled it out? Was it people that were selling? No, it was the government of the country that pulled the money out and the whole investment is inside the country. But it reflects on the chart and people foolishly start selling. What if after election, or even the moment they pull the money out, they now change their mind and they now got funds from some? See, don't follow them to think it is buyers and sellers that is moving this money. You're gonna lose a lot. You're gonna lose a lot. And let's proceed. Another example is after the pandemic that happened in 2020. We all know the whole story about how the United States printed trillions of dollars to boost the economy. They just printed that money. Where did that money come from? It was printed. Was it buyers? Did they buy it? Was it purchased? No. That's what I'm talking about. The supplier. The supplier does not need you to buy or sell or whatever. The sellers, the selling side, the people bringing the orange juice in the orange juice example, the people putting the orange juice in the economy, they have other things that can help them produce the orange juice. And that's what the United States economy did. They printed the US, the dollars in trillions, in massive, and they pumped it into the economy. The moment they pumped it, what happened? USD start buying. Why? Because there's enough. There's enough. There's enough money. There's massive volume coming in as USD. So USD starts going up, 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 up. Was it bias? No. What caused it? The action of the government. You can see that every single thing that happens in this market can be tailed back to the government and the banks. Anybody tell you anything aside this, market maker, whatever, better tell them to go and sit down. They don't know what they are saying. Algorithm, whatever, they don't know what they're saying. Buyers and sellers, whatever, they don't know what they're saying. How many times have you heard it in news that there was this market maker that died, and because of he died, all the currency starts selling? No. But look at when Brexit, the whole Brexit issue happened. You see what happened to the currencies. Look at when the Queen Elizabeth, the Queen of England, passed away. You saw what happened to the currency. When there was war in Iran, and Iran, Gaza, was it Iran, Iraq, Gaza, Iran, Gaza, I can't remember, or Israel, Gaza, I can't remember. But the point is that it reflects when there is famine in the economy. It's not the market maker can do nothing. The market makers are like you. There is no difference between you and me. You who is listening to me, and the market maker, both of you are the same thing. Following somebody who is even hoping for a signal of the economy means that you are, I don't want to use the word that you are short-sighted. Yeah, you're short-sighted. Because the market makers wait for what happens in the economy before they do what they do. So you too must wait for, don't follow these footprints. Leave their footprint alone. What you follow is the economy. And the economy footprint is on the chart. The economy print is on the chart. Everything is there. You just need to be able to read them. Now, what is the determinant of price based on everything I've explained so far? We can now say that when there is volume inflow to AUD, what happens? AUD becomes bullish. That is what determines price. And when there is volume outflow on AUD, AUD start becoming bearish. That is what determines the price for AUD. So all this explanation I've done this morning, see how it now makes sense in determining price. I've not talked about price fundamentals. We'll go into price fundamentals. Well, this is, I've spoken about some of them, but at least this is part of it. So if there is outflow from AUD, what happens? The price drop. And there is outflow on. I could have easily tell you that, when there is inflow, I could have easily told you that, but in the market business model, we don't do that. We explain. When you are trading MBM, you are not trading because of just because of outflow and inflow. No. Or because of this one happened, that one happened. No. We follow context, reasons, understanding. That's what we follow. Because the moment you are telling me something is this, something is that, it means that you do it. It doesn't mean that you know it. It just means that you have it doesn't mean that you understand it, rather. It just means that you know it. Knowledge and understanding are two different things. Do you understand why an inflow into AUD will cause price increase? Now that I've explained it to you, now you know. Starting from the whole example, the orange juice, where we are now. See how I was able to help you understand correlation also. So in this whole class, we spoke about correlation, we spoke about volume, we'll still speak more about volume and correlation, because in correlation we'll be speaking about divergence, but that is later in class. So I spoke about correlation, I spoke about volume, I spoke about the whole economic thing. Okay, before we proceed there, now we can now say that since we now understand the business, I'm sorry, the instrument AUD/USD, and we know that the instrument transaction makes the market possible, this market here. And now we now know the business, the reason why all these things happen. And then we now know what determines the price also. So the inflow could be anybody, the government, the banks, economic factors, scarcity needs, whatever. The outflow could also be in any of these factors. If you can put your money in, you can remove your money. But the other side must have a reason why. Because based on what I explained to you, if everybody's if AUD should be bullish, why is everybody not buying? It is the same reason I've given to you. Okay. Now, remember we are dealing with currency market. So I think I will just have to stop there for today. And in our next class, I'll be talking about, I think we still have a lot to speak about price. A little bit to touch about price, and then we'll now move to price fundamentals, then price delivery. Okay. So if you have any question for me, feel free to go to my Twitter page, follow me on Twitter. Once you follow, please join the community. There's a community there. Join the community and ask your question on the community. Once you ask your question on the community, you will definitely be responded to. But for now, I wish you guys good luck. I wish you the best till we meet tomorrow class. Enjoy the rest of your day.